Hello everybody, it's Doc here from OnTheMoneyOptions.com, and today is March 5th, Tuesday, and I noticed stock this morning, Public Storage Incorporated, that looked like a nice setup for a trade in a very specific range. So I'm going to show you how we structured a trade called an option scalp. And scalp is specifically designed to take care of a particular range or participate in a particular range of move on a stock. So the first thing we're going to look at is the actual chart, and I'll show you what I spotted and what I'm looking at. It's a chart of Public Storage Incorporated, and you can see I have two trend lines on it. The first trend line is from the top about a year ago down to the recent high that we've had. So this creates a little trend line. Inside that trend line is a secondary trend line which connects the tops of that last little move. So I'm particularly interested in this little gap where it has moved above the secondary trend line and probably is going to run into resistance at that top line that's somewhere in the $222 per share range. So this is a pretty expensive stock, and this is a good way to participate in the move without putting a tremendous amount of capital in place. Here's the actual trade that I put on. This is the PSA June series. They're both of the options are in the very same series, the June 21st, 2019. I bought the 195 call for $18.95, and I sold the $220 call for $3.90. So you can see that we've set up a little bit of a structure to take advantage of 195 to 220. Now I'm going to zero in on the option chain and show you exactly what it is that I want you to see, and that is, you'll see that I have the position on here already. We're along the 195, and I want you to pay particular attention to this area right here. This says that we paid 26 cents in time value for the 195 option. Now, more importantly, we sold the 220, and when we sold the 220, we took in $4 of time value. So we paid 26 cents in time value and we sold $4 in time value. So that difference, that $3.70 or so, is going to work to our benefit as we go forward. And this is the whole basis of what's called a scalp. We're actually looking for positive time value. Instead of costing us to be in this trade, we're getting paid each day to be in the trade. So here's a risk profile, and you can see that the current price is just above our break even. Our break even is where this turquoise line crosses zero. The current price is where that magenta colored line crosses zero. So as you can see, we've already built in a little bit of comfort in this if it moves up. Now, you'll also notice that it maxes out right at the 220 level, and we'll go back to the chart and look. That's sort of the area that I think is significant. So we want to participate anywhere between here at this line at the 213 level all the way up to 220, 222. So we've structured this trade to take advantage of that with the least amount of capital. And we've done a couple of things in terms of structuring the trade using a scalp that will help eliminate some of the problems that you wind up working with when you're buying options. So when we look at the overall scope of this trade, the benefits of the scalp are that up front we've defined our risk. We know exactly how much we're risking and how much we can make if this finishes above the $220 range by July. We've gone out about 90 days to give us plenty of time for this to take place. The next thing we've done that's important is that we've eliminated negative time decay. Now, time decay is sort of the rent that you pay for an option. And since we bought 26 cents, we're paying 26 cents to be in this, and we sold 46 cents in the short option, we've actually created a situation where we're gaining on the time value. So we have a positive time value situation, and this is the basis of a scalp. The fact that we have put the option in exactly the same series in the June series means that we've eliminated any effects of implied volatility. What happens to the 195 will happen to the 220 also. So we've eliminated the possibility that you can have an implied volatility blow up or something go crazy and you get out of kilter with this trade. And the last thing we've done is that we've actually created two ways to make money. If this stock goes absolutely nowhere, you see we've lowered our break even to the point where we can make a little bit of money if the price stays exactly the same between now and June. And on the other hand, we've also set up a situation where we can benefit and profit if the stock moves up. So this is called a scalp. This is a really good way to manage the amount of risk that you take in a trade, limit the amount of capital, and get time value working for you. So this is the structure of an option scalp, and I hope that you'll find a stock that you like and you can use this technique to your advantage. So until next time, this is Doc saying so long and stay hedged. Hey there, one more thing before I go. If you like this video, give me the old thumbs up on YouTube and be sure and subscribe to my channel. And if you've got any ideas for something you'd like to learn about, please leave them in the comments below. And if I find something very interesting, I'll try to make a video for you. Okay, thanks again. See you later. Bye.